Hey everyone, welcome to the Your Money Your Life podcast. We're on episode 266 of the pod. Make sure wherever you're listening, you like, subscribe, 5-star rate, and review the podcast. We have a lot to get into today, including we're going to touch back on volatility and a reminder of it because people are forgetting what volatility is and maybe they haven't experienced it before. So we'll talk about that in the roundtable. Of course, we have business news to get through, a lot of it. So let's jump right in with no holds bar, jumping right in, starting with the market update of the day of the week. For those that listen, of course, weekly, we have a lot to discuss because there is volatility back in the markets. Now, is that a bad thing? No, not necessarily. People need to understand what the markets are and what volatility means and what investing means, what long-term investing means versus short-term. So the big thing right now is there are tariffs. There's a tariff war potentially brewing and may have already kicked off. There's U.S. tariffs on Canada, Canadian, Mexican, and Chinese imports. Those took effect this week. They did bring volatility back into the markets. Canada and China responded with retaliatory levies of its own, while Mexico said it would unveil measures over the weekend. So with that, you saw volatility in the markets, and that's the geopolitical risk that I was talking about earlier that might upend some of the momentum you saw in the market, and it is doing that, right? So that's one thing you're seeing the major indexes kind of dropped on this news, but the benchmarks yesterday, the major indexes, the stock market got a boost yesterday after the White House said it would grant a 1 month delay for tariffs on automakers whose cars comply with the United States Mexico Canada agreement. So that's the big move in the markets right now. There's tariffs on automakers, there's tariffs on other countries. Um, so that's the big thing that's driving the market. As you can see, even today, this morning, a little bit more pullback in volatility. Now, is that a bad thing? No, not necessarily, right? Like that's potentially an opportunity for, again, longer term investors. We've seen volatility before. Let's go to our chart. Let's pull it out 5 years. Let's even pull it out 1 year and see what volatility means. Remember in the summer, July, August, we had a dip. People would have told you the world was ending then. And we recovered and went to new highs. Now we're having a pullback, a small pullback correction. People are going to again say the world is ending, and it's obviously not true. Like the people that emotionally invest or are not understanding how to play or how to strategize around pullbacks and corrections and see those opportunities are going to do what they always do, sell, try to day trade, and end up losing money at the best breaking even, but more than likely, 99% of these people end up losing money. So that's the big thing we'll talk about in the roundtable. But let's first and foremost go to our news updates. There is a layoff surge on Doge cuts. So, those aren't familiar with Doge, Doge is a Department of Government Efficiency that's led by Elon Musk, and they are pretty much going through different federal departments and slashing workers, slashing jobs. And this is something that we warned about prior at the beginning of the year on CNBC, that there would be potential job cuts with this Doge mandate. So layoffs rose 245% in February. That's compared to the month prior, according to data released by a independent firm. Of the roughly 172,000 people who were let go last month, more than one third, or 62,000, lost their jobs to cuts by Department of Government Efficiency. That's 62,000 job lost by Doge itself. So this is going to be troubling in the sense of, when jobs are lost, there does a couple things. So of course, people, on a broader scale, when jobs are lost, spend less because there's less income. But then, it also puts fear in other companies and other people about the fact that there will be no growth and they will also start hiring or start making cuts as well. Like, so it's a trickle down effect that will probably potentially seep into the private sector because they'll realize that, okay, there's going to be less growth because there's people getting fired, there's less income, less spending, and so they'll also make measures that are indicative of a lesser growth environment, which will eventually catapult us into that less growth. So that's the big thing you're going to see, and it's not good news on the job front. Anyways, let's dive into tariffs. What is going on? There's tariffs delay for the automakers. So U.S. automakers will be given a 1 month reprieve from new tariffs on Mexican and Canadian imports. This was announced by the White House. The reversal followed a meeting between administrative officials and the heads of auto giants Ford, General Motors, and Stellantis, according to Bloomberg. So they all met with the administration and they said they'll give you a 1 month reprieve for those trucks that are being produced and manufactured in Mexico and Canada, and then now coming into the US, right? So, like these tariffs for anything imported into the US, and now these automakers that are maybe US based, they have to comply, of course, with these um, rules, but they're giving a 1 month reprieve to the automakers because the auto industry is in a lot of flux, right? Like you have used cars being chart cost incredible amounts. You have old new cars being astronomical prices. So this is good news for the automakers, at least for a month, unless there's a deal struck within the month time frame, which people think they're getting closer to a deal on the Mexico and Canada front. We'll see if they are. But this tariff war is impending, and it's going to be something that's going to probably lead the theme of the markets for a little bit here. Let's jump into OpenAI. So OpenAI preps $20,000 AI agents. So I think this is really interesting. This is really, let's read more about this and what this is. So OpenAI is readying new artificial intelligence agents that will be priced between 2,000 and 20,000 a month. That's crazy. But it may be useful for some people. It's accelerating its application business, reports the information, citing anonymous sources. These agents will perform specialized tasks that typically require human expertise and come in varied tiers, from high income knowledge workers to PhD level agents that can perform automatic coding and test hypotheses. Sources expect the products will drive 20 to 25% of total revenue. That's interesting. So AI agents is the next thing. If you think about it, I actually had a demo or saw a demo on it. Pretty much they're able to like browse, search your internet, like do tasks that you ask it to do, like literally in a portal, like say, hey, email this person to do XYZ. It could log into your platform. It could go in and email the person um, while you're doing other work on another screen or another tab, right? So these agents are gonna really like do a lot of things that like assistants or a lot of things that like junior workers or junior associate workers will be able to do. And so this is it's gonna be kind of a groundbreaking thing, and it's gonna be make it's really going to make what I've pushed for a long time or understood for a long time, less workers and solopreneurs thrive, right? Because if you have something that could do a lot of work for you, you don't have to hire as much. The solopreneur, the less workers, you're going to see businesses. We've already talked about this. You'll see businesses that will be thriving and striving just with one or two people. That's because you have these AI agents, you have artificial intelligence that's allowing you to get so much more done without hiring. Yes, you're still paying, but I think that cost will come down over time because it's a lot, but you will see that cost come down, especially when you have replicates of OpenAI's portion of this that come in at a lot cheaper. They're gonna have to drive. They're gonna drive that cost down. So, OpenAI is planning to launch a suite of specialized enterprise agents with with specific professional roles. They're going to be a high income knowledge worker. That's going to be 2,000 a month. Software developer, 10,000 a month, and PhD level agent, 20,000 a month. So yeah, those prices are a little bit a lot. OpenAI is just trying to recoup their losses. To be honest, those prices will definitely have to come down, but it will become widespread. It will become much more widespread. It will be a lot less expensive when everyone knows how to use it and there's replicants of this. So that's really, really interesting. Keep your eye on that and actually test it out. Like that's something you should be testing out. Jack Daniels is being dropped from Canadian stores. So this is back to the tariff wars. We're going back to tariff wars. Jack Daniels is feeling the impact of the newly implemented tariffs on Canadian goods, but not just from the levies directly. Parent company Brown Forman is taking a big hit as Canadian businesses seeks to retaliate against the U.S. and they're pulling American liquor off their shelves entirely in a move he describes as a disproportionate and worse than a tariff because it's literally just taking away your sales. So the Jack Daniels parent company is pretty much saying, "Hey, you can't just pull us off the shelves. At least let us stay on the shelves in Canada and let the people decide if they want to pay a premium." But Canada's saying, "Hey, we're just going to pull the liquor off your shelves, and so you American companies are not going to be able to sell in Canada as a retaliatory effort against the US. Again, this is going to be the big theme, tariffs. I think again, what's the long short of it? This will end up working itself out. I think a deal gets done. There'll be short-term volatility. I do think a deal gets done relatively quickly. Both sides need it. Both sides want it, and a deal will be done at some point. But there'll be short-term volatility. We'll talk about what that means in a second. Let's look at some other news. Pancake, pork, and pancakes. What tariffs touch? Okay, so this is a good chart for all my YouTubers. This is showing what tariffs touch and where what companies are going to be hit the most in sense of tariffs. So that's a good chart for people to really dive into if you get a chance. And so the VIX we'll talk about. It's the fear gauge. It's going up. It's a volatility gauge, I should say, not a fear. Is just more of a sensationalized word. It's a volatility gauge, and it's going up. But that's fine. That's understandable. So this is more tariff stuff. We're gonna skip through it and come back to it. More tariff stuff on the previous. There's so much that's the main theme. So let's actually go to the round table and talk a little bit about what it means to have volatility back in the market. So again, volatility is not necessarily a bad thing. You're not just gonna have the market go straight up, right? Like if people are expecting that or thinking that, you're just fully not understanding what investing is and what the market is, right? Like let's look at this 5-year chart. Um, Many of our clients have been here for over 5 years, right? The industry's been thriving for a long time, over half a decade. If you saw here, we had so much different things that happened, and if you would have thought you would have thought, so this is the COVID bump. It's actually not even showing anymore because we're almost way past that time frame. I want to even go further out. So this is the COVID bump. It looks smoother when you pull out. Like this is the thing, you need to have a bigger perspective. It looks so much smoother when you pull things out. The 2022 jump where everyone was told the world was ending, and now we're seeing a little bit of correction on the news of the tariff wars. So let's say this, you have to understand that volatility is a part of investing, and it's actually could be opportunity for investors. How is it an opportunity? Well, if you're a long-term investor, let's look at this chart. Let's look at this graphic. Um, you may or may not be able to see it, but it's like thinking about the time frame of investing and why longer is better and why taking advantage of opportunities is better. Look at the daily the time frames on the left, whether the market was positive or negative, on the right and to the further right. And if you look at it, if you invest, we talked about this before. If you invest for a 1 day time frame, tends to be positive 54%. If you invest for 1 quarter, so 1 quarter is what, 3 months? The chance of your returns being positive are 68%, so they went up. If you invest for 1 year, the chances are 74%, 5 years, 86%, 10 years, 94, and 20 years, 100%. That chart is pretty much saying, understand that the odds of making money in the market in long term are very high and you will experience volatility, but that's okay. If you are smart, you should be actually saving cash, adding cash in the times of volatility to take advantage of that because you can buy assets at a lower valuation that could be quality assets. You could buy into the weakness at quality assets that are more attractive prices. If a nice car that you wanted went dipped in price and you were like, oh man, this is a house, for example, dipped in price that you wanted, and you knew it was a really good house, you knew it was a really attractive asset, you would buy it and you would hold it because you know that your value will be returned to you. So that's what people are missing on this, but it's understandable because emotion drives um, most of people's thought process when it comes to investing than anything else. So that's another thing to know. So let's look at this chart. This chart is saying, it's just telling you a little bit more about volatility and why people literally forget to understand that it will pass. And I think most people that we've worked with understand that now because it's been such a long time. We've seen everything. You've seen COVID-19, you've seen um, a bear market, you've seen everything under the sun. And so I wouldn't try to like time this or day trade. A lot of people forget that fear impacts opportunity. If you try to time the market and move money out when you think it's going to crash and then move it back in, you're never going to time it correctly. You're just going to miss out on the gains. You're just going to really miss out on the gains that are because there no one's going to tap you on the shoulder and tell you, okay, now it's time to put it. You're going to miss out on the recovery, which is what everyone does in this time frame, right? So for those that if you're worried about like investing or any of that stuff, you probably have maybe too much money, maybe too emotionally tied. Maybe you need to budget and save it and have more income versus worrying about like trying to day trade your way into some sort of wealth. It's just not gonna occur. The best thing to do is add cash during volatility times. Have that attractive assets that are at better valuations purchased, and ride out and be patient on any of those things. So that's a big thing for people to remember. You haven't seen volatility for a while. Maybe you forgot how it goes. Maybe you forgot how the market goes. But this is a good refresher and reminder for you because again, these things do occur, and you have to understand to work with our clients are lucky to work with an expert to help them understand how to frame the thought process around this because there's going to be volatile times. We thought it'd be a little bit later after we're almost ending the first quarter, first after roughly in the second quarter, after midway through the second quarter, a little bit after. But um, again, I think a deal gets done at some point. Honestly, there has to be both sides needed. A deal does get done, but again, this is a good reminder on volatility and how to think about it during these times. I think the best thing to do is for patience and adding cash because these waves always ride out. That's just a very common. This is not even if you think about it, look at the chart. It's the wave is not even really that crazy yet. Honestly, honestly. But that's a good thing to think about, folks. Remember that. Stay tapped in to New Street. We have a bunch of webinars, seminars. We did the Knowledge Hub at Freelancers Hub yesterday and the day on Tuesday and Wednesday, helping folks that are freelancers understand a little bit more about their finances and how to approach it. Then we have a graduate talk here at Morgan State virtually here today on Thursday. We have so much coming up the pipeline. We have more webinars and seminars over the spring and summer. And then Issue Sports. We again too much going on. This is a busy month, but we appreciate you. Make sure you share this with family and friends that are interested on learning more about their finances. We will talk next week.